Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about a popular topic for most physicians, or I guess unpopular, depending on how you look at it, but that's taxes. And I had an experience the other day that I thought illustrated taxes pretty well. So I was having breakfast with my family, and my 3-year-old asked if he could have a big boy cup without a top on it for his water. So my wife and I reluctantly filled up his cup for him, but by the time he actually sat down to drink out of it, he ended up only having about 2/3 of it left, maybe even less, after spilling a bunch of it on the walk to the table. And I decided not to point out the analogy to him, but this is a perfect example of taxes. We all have our full cup of water, which is our total income, but before we even get a chance to drink from it or use the money, the government takes a certain percent. I wanted to explain to him that this is how taxes work, but I think I'll save that for a later time.
It's never too early to explain taxes. It feels like a missed opportunity here, Trent.
Next time I won't let it pass. So I think it's safe to say that no one likes paying taxes, but they're an ever-present part of our financial lives. So rather than wishing you didn't have to pay them or hoping that they'd go away, it's better to instead focus on how to minimize the amount you pay. And it's important to have the right time horizon in mind. The goal shouldn't be to minimize your taxes in a particular year, but rather to minimize your lifetime tax bill. We often talk about this as not missing the forest for the trees. It's also important to understand the difference between tax preparation and tax planning. So tax preparation is reactive. It's about taking the information and events from the past year and using them to figure out how much you owe in taxes. Whereas tax planning, on the other hand, is proactive. It's about looking ahead to the future and figuring out the different things you can do to reduce the amount of taxes you'll owe. Also know that there's no silver bullet when it comes to taxes. There are limits to the ways you can save taxes, and unfortunately, as a high earner, you'll have to pay more in taxes than the average person. And when we think about tax planning for physicians, there are really 3 distinct stages based on where you are in your career, whether that's in training, the years working as an attending, or in retirement. And the strategy and approach will be different depending on where you are along this path, because your tax rate and your available options when it comes to tax planning will change and evolve over time as you progress through these different stages. And for our discussion today, we're going to focus on that middle phase, which is the years when you're working as an attending, or the period in between training and retirement. During this period, you're likely at or near the highest tax bracket of your lifetime, so the goal for most physicians should be to minimize your current tax bill and defer taxes to the future, retirement, when your tax bracket will likely be lower. And there are many different ways to do this, and we'll walk through them one by one, but one of the first places to look is at your employer's retirement plan.
Yeah, and this is a great place to start because it's the best way to pay less in taxes and also save toward retirement at the same time. And so your employer retirement plans are accounts like your 403b, 401k, or your 457b. And it's a retirement plan that is sponsored by your employer and allows you to save toward retirement in a tax-advantaged way. And in the past, employers would often have pension plans where you worked at a company for 30 years and then retired, and your employee would pay you a percentage of your salary. And it was your pension and Social Security that predominantly made up your retirement. But transitioning to today, and almost every employer is going away from the pension plans and instead shifting the responsibility of saving toward retirement to the employee. And that's where these employer retirement plans come into play. Typically, the employee makes a contribution and they'll receive a matching contribution. For example, if you put in 5% to your 401k, your employer will put in an additional 3% in your behalf, which is called that matching contribution. And you're usually able to make either traditional contributions, which give you a tax deduction today, but then you have to pay taxes in the future when you withdraw from the account. Or you can make Roth contributions where you don't get a tax deduction, but then you don't have to pay taxes on the growth or what you take out in the future. And so when you're looking at what's the best way to save to your retirement plan, it all comes down to comparing your tax bracket today versus where you expect tax rates to be in the future. So if you're in a lower tax bracket today relative to the future, then it makes sense to make Roth contributions. And if you're in the higher tax bracket today relative to the future, then it makes sense to make those traditional contributions. And so for physicians, like Trent mentioned earlier, we have a couple different phases that we think about it. During training, when you're likely in the lowest tax bracket you'll ever be. So that's where you want to make sure that you make Roth contributions because that's typically going to make the most sense. Versus as an attending, you're going to typically be in the highest tax bracket you'll ever be in. And so that's where you want those traditional contributions. And the reason for that is because you'd rather get a tax deduction today when you're making $300,000 and then take out the money in the future when you're only making $150,000. And you're going to be paying tax at a lower rate at that point. And then we all have a capped amount you can contribute to your employer retirement plans. And so in 2020, that's $19,500 as an employee contribution, or $26,000 if you're over age 50. And so when you're thinking about the actual benefits, it helps to quantify what the actual savings will be. And so if you're thinking about a typical physician in Michigan, if they're at the 32% marginal tax rate, every dollar that you're saving is going to be 36 cents in taxes between federal and Michigan state taxes, roughly, that you're going to be saving. And so if you put in the maximum amount to your 403B, that's going to be $7,000 in taxes you're saving. Or if you're over 50, it'd be $9,400 roughly that you'd be saving in taxes. And the more you save, the more you save. You know, you're saving for retirement, but you're also getting those tax savings as well. And so when you're thinking about the tax savings, you also want to understand that when you're contributing to those retirement accounts, the money's also going to grow tax-free. And so you're saving money along the way in addition to that retirement savings that you're doing. And this is why we always recommend filling up your tax advantage space first, because not only are you saving toward retirement, but you're also getting that double benefit of saving on taxes.
In addition to your employer's retirement plan, there's another great way to save on taxes through your employer benefits, and that's through either a health savings account or a flexible spending account. In basic terms, these are accounts that you can contribute money to for things like healthcare and dependent care costs and receive a tax break at the same time. We'll walk through them one at a time, but we'll start with a health savings account. Not all employers offer this, but it really is a great option for those that do. And the way it works is you contribute money to the account, you receive a tax break on the contribution, and you can then spend the money on qualified healthcare expenses. And those are things like deductibles, co-pays, those out-of-pocket expenses you have. And the great thing about the tax deduction for the health savings account is that you save on federal, state, and payroll taxes, which is even better than what you have with the 403B, 401k, or 457B, where you contribute and just save on federal and state taxes. The annual contribution limit for a health savings account is $3,550 for an individual or $7,100 for a family. So for a Michigan physician in the 32% marginal tax bracket, that's around $2,600 in annual tax savings if you're making that full $7,100 contribution. And one thing to note is that you have to have a high deductible health insurance plan to use an HSA, although what typically happens is the tax savings of contributing more than offset the higher cost of the deductible. And another thing to understand about health savings accounts, which not everyone knows, is that they can actually be used as another retirement account as well. And the way it works is that prior to age 65, health savings account money can only be used to pay for qualified healthcare expenses unless you want to pay taxes on it plus a 20% penalty. However, after age 65, the money can be used for anything without incurring a penalty. You just have to pay taxes on it, which is similar to a traditional IRA or pre-tax money in your 403B, 401k, or 457B. And many HSAs allow you to invest the money, so you can invest your contributions and the money can grow tax-free over time. So this really is a great benefit for physicians who have access to it, but unfortunately not all employers offer the HSA option. And much more common than the health savings account is another type of account called a flexible spending account, or FSA. And there are two different types of FSA accounts. You have the healthcare and the dependent care. And similar to a health savings account, you receive a tax break when you contribute. That's federal, state, and payroll taxes. And you can then use the money to pay for either qualified healthcare costs or dependent care costs, depending on which FSA account you use. And qualified healthcare costs are things like the deductibles and co-pays, so similar definition as the health savings account. But then qualified dependent care costs include things like daycare and private babysitters. So the dependent care FSA is really great for working parents who have younger kids. So while there are some similarities between a health savings account and a flexible spending account, there are also some key differences, in particular, less flexibility for a flexible spending account, which is kind of ironic if you think about it. But most importantly, this account is a use it or lose it account. So prior to COVID, I had a flight booked for a conference. And when the conference was canceled, I had to call the airline, cancel my flight, and get a refund. And I was able to get a refund, but it was in the form of a credit to be used on another flight within a year. And this is exactly what an FSA is like. The contributions are use it or lose it within a year. So like the airline voucher, it's great to have, but it becomes worthless if you aren't able to use it within the allowed time period. And this doesn't tend to be as much of an issue with the dependent care FSA, since childcare costs tend to be pretty predictable, but it can be more of an issue for a healthcare FSA, since sometimes healthcare costs can be more variable. And another key difference between the HSA and the FSA is with the FSA, you're not able to invest the money. So because of that, you're not able to earn a return on the money you have in that account. And lastly, another key difference is you're typically only allowed to make a change to your flexible spending account one time a year. And that generally happens in the fall during the open enrollment period. Although sometimes if you have what's called a qualifying life event, so things like getting married, having a kid, other similar events, you're able to make a change then as well. So there are a few drawbacks to an FSA compared to an HSA, but still it can be really valuable in terms of the potential tax savings. And in 2020, the limit for contributing to a healthcare FSA is $2,750. So for that physician in the 32% tax bracket, that's about $1,000 in tax savings. And the dependent care FSA has a $5,000 contribution limit, but it can be lower for physicians. And that's because employers have the ability to adjust limits for high earning employees, which can come into play given your income. So for example, University of Michigan caps the dependent care FSA contribution at $3,600 if you make more than $125,000. But even so, that's still close to $1,400 in annual tax savings for someone in the 32% marginal tax rate. So overall, a flexible spending account isn't quite as good as a health savings account, but it's still a great way to save on taxes. And if you're going to be spending money on these things anyway, healthcare costs, dependent care costs, why not save some money in taxes in the process? Now, so far, we've focused on ways to save taxes related to your employer and your income from that employer, but we also have a number of clients who are employed by large health systems, but also have side income. And many people don't realize that there are some great tax planning opportunities available if you're in that situation.
Yeah, it really is a unique situation for physicians with some of those additional opportunities to work and make money outside of just your employment. You know, whether that's consulting, moonlighting, or speaking and writing, you have a lot of opportunities available to make some additional income, which also means you have additional opportunities available to save on taxes. And as a physician with side income, you're viewed as both the employer and employee for the additional income. So instead of receiving a W-2 from your employer at tax time, you receive a 1099, which outlines the income you received from your side income. And so when you're thinking about that side income, you can do a couple of different things. The first one with the additional side income is that you can set up a business for yourself. It could be a sole proprietorship or an LLC. And this allows you to more easily track the income and expenses. And you can even deduct certain business expenses like a computer, travel, home office, things like that. And it also allows you to open up an additional retirement account for self-employed individuals. So you can set up a SEP IRA or an individual 401k, and that allows you to potentially save even more toward retirement in addition to what you're contributing to your employer's plan, like a 403b or a 401k. And we won't go into the details in this episode, but the main thing to be aware of is that you have options to potentially save even more toward retirement using some of that side income that you have. And to give a quick overview though, like we mentioned, we all have limited tax advantage space to save toward retirement. And so when you're thinking about the contributions you can make, you're only allowed to make one employee contribution, which is that $19,500 if you're under age 50 or $26,000 if you're over age 50. But you do get a total contribution of $57,000 or $63,500 if you're over 50 between the combination of your employee contribution and any employer contributions. And so if you're thinking about where you're working on your day job, you have no control over what your employer contributes or matches to your 403b. But with the side income, remember that you're both the employer and the employee. So that allows you to make an additional contributions as the employer on behalf of yourself to get you closer to that $57,000 cap amount you can have in total in those retirement accounts. And so if through work, your combination of employee and employer contributions is less than $57,000, then you have additional income from outside work, outside of your main job, you may be able to make additional employer contributions to your individual 401k. And so it's important to understand the rules, and it is case by case with how much you can contribute. But the goal is just to be aware and understand the options you have, and then talk with a qualified CPA to help with the exact contribution amount that you can make.
And by this point, you're probably getting sick of hearing numbers and acronyms, but we're going to throw one more at you. and that's a 529 plan. And this is an account that provides an opportunity to save on taxes if you're saving for college. And not just for parents, also for grandparents, aunts, uncles, or even friends. And there are many different ways to save for college, but a 529 plan tends to be the best. And it really is a great way to stretch the dollars you save as far as possible. As I've mentioned, I have 3 young kids, and each of them has a 529 plan. And based on the trends in tuition inflation, I think it's going to cost about as much as a house for any of them to go to Notre Dame. So I'm trying to be as efficient as possible with their college savings. Although my wife says they can just go to U of M instead. So problem solved in her mind.
I'd second that.
Of course you would. So when it comes to 529 plans in Michigan, there are 2 different options, and we'll have a dedicated episode in the future on college planning in Michigan. So for today's discussion, we'll keep things a little higher level. And one of these options is the Michigan Education Savings Program, or MESP. And what this is a saving and investment account, kind of like a 403B or a 401k, except for college instead of retirement. You contribute money, you can invest that money, it grows tax-free, and you can eventually withdraw it tax-free to pay for qualified education expenses like tuition and room and board. And the other 529 option in Michigan is the Michigan Education Trust, or MET. And this is a prepaid tuition program where you can buy future college credits at today's prices. So theoretically, your rate of return will end up being the rate of tuition inflation. When it comes to contributions to either of these, there's no annual limit. The only limit is that you can't have more than $500,000 per beneficiary in one of these accounts, which definitely isn't an issue for most people. But from a tax perspective, the nice thing is that when you contribute to a Michigan 529 plan, you receive a state income tax deduction, although not a federal tax deduction. Michigan's state tax rate is 4.25%, so that ends up being $425 of tax savings for each $10,000 you contribute. And it's also nice that there are no income restrictions on who can receive the deduction, so it's available whether you make $150,000 or $1 million. The only restriction is the size of the deduction for the contributions to the MESP plan. For both the MESP and the MET, you can contribute as much as you want each year, but for the MESP, you can only deduct up to $10,000 in annual contributions for state income taxes, whereas for the MET, there's no limit. Also, keep in mind that the MESP tax deduction is based on your net contribution. So it's important to know if you have a child in college and 1 or more younger children as well. So if you're withdrawing $20,000 per year from the 529 for the child in college while contributing $20,000 per year to a 529 for a younger child, those contributions and withdrawals will offset each other, so you won't receive a state tax deduction. One other thing to keep in mind with 529 plans is that each state has its own plan, and you are free to contribute to another state's plan. You just won't receive any of your own state's tax benefits by doing that. Again, we'll have a dedicated episode on college planning, but we wanted to talk about it in the context of tax planning and as another tool that you can use to reduce your taxes. Now, you may or may not have noticed this theme so far in the conversation, but if you think about the tax breaks we've covered, you'll see that the government provides tax incentives to encourage certain behaviors. So far, we've talked about incentives for saving for retirement, healthcare, and education, but another one is charitable giving.
Yeah, and before we dive into charitable giving, we know that not everyone has charitable intentions, especially earlier on in your career when you're trying to pay down debt, save for retirement, and start a family. But we know that over time this may change. So we want you to at least be aware of the way to maximize those contributions if and when you decide to make them. And similar to college planning, we'll have a whole episode eventually on this, but we want to stick to the basics. At the most basic level, when you prepare your taxes, you have the option of taking the standard deduction, which everyone is eligible for, or you can itemize your deductions. If you have more deductions you could group together, that would end up being higher than that standard deduction. And so when you make charitable contributions, they count as an itemized deductions. And so you can group those with things like interest expenses from your mortgage and real estate taxes. And then prior to tax legislation in 2017, many taxpayers actually itemized their deductions because they were easily able to add up more deductions above the standard deduction, which means they could fully capture the benefits of charitable contributions each year. However, charitable giving in general has changed a bit with the legislation passed at the end of 2017 because now there's a much higher standard deduction. Today it's $24,400, and so the hurdle rate of itemized deductions has to be a lot higher in order for you to benefit by itemizing those deductions. And there are also caps in place now on certain deductions, like the amount of interest you can deduct and caps on the total amount of taxes you include in your itemized deductions. And for some of those reasons, most taxpayers are going to just end up using the standard deduction each year, which means your charitable contributions may not even provide an additional tax benefit. And we know that not everyone donates to charity just for the tax benefit, but we at least needed to point that part out. However, in light of the changes, there are a couple ways that you can do to maximize your charitable contributions by taking advantage of what's called lumping your gifts together. So effectively, you can make all of your charitable contributions every other year. And this allows you to have some flexibility in different years where you have the deductions that are going to be above that $24,000 standard deduction limit. And then in the off years, you'll just take the standard deduction. And you can lump your charitable giving by taking advantage of things like contributing to a donor advised fund. And a donor advised fund is just like a 401k for charitable savings. You put money in, or you could donate appreciated investments, and you'll get a credit for the full charitable contribution in the year that you make it. Then in the future, whether that's this year or 5 years from now, you can choose how you use your donor advised fund to distribute to charities however you'd like. And regardless of if you utilize a donor advised fund, when you're thinking about how to make your charitable contributions, you want to be aware of your options. And 3 strategies to be aware of are, first one, gifting cash. The second one is looking at how you can donate from your taxable account. And the third one is what's called a qualified charitable distribution, which is from your IRA when you're making those charitable contributions. And so if you're thinking about the first option of gifting cash, this will still get you the full tax deduction, but it's not the optimal way to give to charity. Instead, a better option is to donate appreciated investments from your taxable account. So let's say you have an investment that you bought for $1,000 and now it's worth $10,000. Well, if you sold that investment, you'd have to pay taxes on the $9,000 of gains. So if you tried to sell an investment to then donate to charity, you'd be stuck paying the taxes on the gains. However, instead of selling the appreciated investment, you can donate it directly to charity. So you'd still get that same $10,000 deduction, but you avoid having to pay taxes on that $9,000 gain. And the other benefit is that because a charity is a tax-exempt entity, they won't have to pay tax on the $9,000 of capital gains either. So it's really a win-win. And then the third one, which is more important and relevant later in life, is that qualified charitable distribution. And so for physicians that are younger than 70 and a half, this isn't relevant yet, but something to think about in the future. And a qualified charitable distribution allows you to move money directly from your IRA to charity. And so you get the tax deduction for the amount you give, but the other additional benefit is that you don't have to pay taxes on the amount out of your IRA. And the reason this is so beneficial is that once you're 72, you're required to take a set percentage of money out of your IRA every year, which is called your required minimum distribution. And by doing a QCD or qualified charitable distribution, you can satisfy your RMD in that year and also make your charitable deduction. And like we mentioned, giving to charity is usually based on your desire to give back. But if you are going to give, we want to make sure that there's nothing wrong with the ability to try and do it in the most tax efficient way. And charitable giving is a great way to save on taxes. But as you're thinking about any of these strategies or tax planning in general, you want to make sure that you don't let the tax tail wag the dog.
And the last tax planning strategy we're going to talk about today is tax loss harvesting. And this one is relevant if you have a taxable investment account, which is also commonly known as a brokerage account, an individual account, or a joint account. And the way tax loss harvesting works is that if you have an investment with a loss, you can sell it to recognize the loss and immediately buy another investment in its place. And what that allows you to do is capture the loss for tax purposes while staying invested. And this is important because the best tax loss harvesting opportunities tend to happen during periods when the market's down. So you want to remain invested to capture the eventual recovery. For example, we did a lot of tax loss harvesting for clients in March and April of this year. So it was important that clients remained invested as the market subsequently bounced back, in this case in dramatic fashion. One thing to note is the investment you buy in place of the losing investment must be considered substantially different. So be sure to keep that in mind when thinking about this. And one other thing worth mentioning is that people sometimes have this aversion to the idea of, quote, taking a loss on an investment, and they'd rather wait for it to recover instead. But recognize the value of tax loss harvesting and try to view this as an opportunity since you still remain invested, but you can capture a tax break in the process. In terms of the limits and tax benefits, you're allowed to deduct up to $3,000 of losses each year, but you can also carry unused losses to future years. So for example, if you sell an investment and capture a $15,000 loss, you can then deduct $3,000 per year from your taxes for the next 5 years. For that physician in the 32% marginal tax bracket, a $3,000 deduction saves you about $1,000 in taxes, which is a nice benefit. The way we look at tax loss harvesting is that it's kind of a silver lining during those periods where the market's down, and it gives you the opportunity to at least do something to capitalize on it. So I know we've covered a lot today, but We wanted to make sure we gave you a comprehensive overview of some of the different things that you can do to minimize your tax bill as a physician. As a summary of the main points and action items, you want to look at the following areas for opportunities to save on taxes. Retirement savings. So consider your employer retirement plan, and if you have additional side income, review your options when it comes to setting up a business or an individual 401k. Healthcare and childcare. Look at a health savings account or a flexible spending account if you have those options. Education. If you're saving for college, as a parent, grandparent, or otherwise, consider using a 529 plan. Charity. Think about whether you can use some of the strategies we discussed to maximize the tax benefit of your charitable deductions. And lastly, investments. If you have a taxable investment account, look at opportunities to harvest losses for tax purposes, especially during periods where the market's down. As you can see, there are many different ways to save on taxes, and there's really no reason to pay more than what's required. A client of ours jokingly referred to tax planning as legal tax evasion, but the point is valid. It's about playing within the rules set by the government to take advantage of the deductions and opportunities available to you to minimize your taxes. Also, while tax planning is a key part of the financial planning work we do with our clients, know that we're not licensed tax professionals, and we encourage you to talk to your accountant or CPA before implementing any of the strategies discussed here to see whether they make sense for your situation. We hope you enjoyed the discussion, and hopefully it'll allow you to keep a little more water in your cup than my 3-year-old, who I think we decided is going to stick with the lid for now. Thanks for joining us for another episode of the podcast. We certainly appreciate the time you spend with us. We hope you find the content helpful, and we love to hear feedback. So if you have thoughts to share about the show or questions you'd like to have answered, feel free to email us at info@mdwmllc.com. You can also visit the podcast page of our website to access the show notes and everything we covered today. We'll also include in there a blog post we wrote on how to save taxes as an attending physician. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.